Hey guys, Sean Taggy here. We are chiming in for our third and final day of the Sofa Summit. Thank you so much, everyone, for participating, for giving comments to us, asking questions, all the great reviews and fans that we've had. We're so grateful for all of our clients that have bought a turnkey property from us or invested with us in some way and for being here. Today, obviously, on the Sofa Summit is multifamily investing. So trading in those greenhouses for a red hotel or a big, large multifamily. And that's what I'm going to be going over today, some case studies of some multifamilies that we've done. So let me share my screen here and present. Yeah, so here's what's awesome is that we have done about collectively the partnership. Well, Jim Reedy, our senior partner here, he's done tens of thousands of apartment buildings over his career. He currently owns probably over 1,000 different apartment buildings. And of that, 650 about the Memphis Investment Property Partners have syndicated, meaning we brought in other investors to join in with us, and then the others they just own personally, the different partners of MIP. In case you don't know me, I'm Sean Taggy, the partner and chief operating officer of Memphis Investment Properties. And yeah, I'll be going over two in particular multifamily apartment buildings that we bought and have owned for just over 2 years and just barely refinanced. So let's dive on in. Before my lawyer makes us state this disclaimer. All financial information is deemed reliable but not guaranteed. Performance and projections are estimated and subject to change. The provider shall be held harmless if returns are not met. All investments have risks, and investors are urged to perform their own due diligence and seek professional assistance. Actual results may vary, right? This is real estate. This is life. This is not a solicitation to buy or sell any private placement memorandums or securities with us. It's just for educational purposes. These views and opinions are for informational educational purposes only. So now that we have that out of the way, let's go into one of our first multifamily apartment complexes that we syndicated with other investors. So this one was purchased May of 2020 for 3.4 million, and it was 124 units. So very low purchase price if you look at that. And the reason being is that this property was very dilapidated, very needed a lot of repairs, and very low occupancy. So 56% occupied. Those in the multifamily space would be like, this is a heavy lift. This is a lot of work. A lot of people just don't even go for this because it's just too much risk for them, especially if you're out of state investing. I don't know if you could take this on. So it really worked just for us because we're local. We have boots on the ground and lots of experience with really rough properties like this. We tested this whole strategy on several other apartments before with our own money, made our own mistakes with our own money, right? And then brought it on with investors. So we felt confident we could do this because we've actually proven it, had other apartment complexes nearby and lots of single family rentals that we could take on. And even at 56% occupied, it wasn't even fully collecting, only 80%. And so we got a loan. It's called a bridge loan. A bridge loan is like a short-term 1 or 2 year, maybe 3 year loan. It's not like a long-term 30-year fixed loan. It's just a short-term loan from a local bank here. It's at a higher interest rate, like 6% or so. I mean, still pretty decent, 5 or 6%. Short-term, as I mentioned, and it was amortized over 25 years, but then had a 2 or 3 year balloon, meaning the whole loan was due in that time. But of course, you could refinance before then. They had some extensions and everything like that. And so yeah, we raised 2 million of equity, but we used debt for the rest of it for the purchase and reno. And market rents were very low because the units weren't in great shape. So at $550 a door was what they were at that time. And we knew that we could come in and fix it up. So here's one of the units. Now, this isn't what this one wasn't an occupied unit, but basically the owners were just kind of just letting it go down. Is they weren't reinvesting equity back into the deal. They're kind of just trying to juice it for everything. Like, for example, 2 of the units had a fire in it. So, they had a small fire and they burned down. They just took the insurance money and didn't re-renovate the units and get them back online. So a lot of the units were like this, just kind of sitting there, not even being rentable. And then the ones that were rented were very outdated. So yeah, like the roofs and shingles, a lot of the exterior needed work. There was erosion problems. The sidewalks weren't in great shape. Lots of the rails around weren't good and fallen down and safety hazard. The roofs, all of them needed replacing basically. A lot of the ACs, some trees, the fences around the property. So I mean, pretty much everything needed a lot of work. So these are some before pictures. Just needing some work and jobs kind of just half finished and other things like that. So here was our strategy, right? We're going into this. We're well aware of what's going on. We did a full due diligence, made a full reno budget on it, and here was the plan. We already realized that the management on site was not working well, so we fired the current property management company and brought on our own, right? So we had kind of control over everything. We had control of the property management owned by Reedy and Company, Jim Reedy, the partner of MIP, his sister company. And so we brought on a new on-site property manager, and that person has already worked in this area, already knows how to deal with this type of area and tenant base, and very experienced in it. So this new property manager, she became the sheriff in town and really watching everything and changing it from the Wild West to, kind of the new century age, right? Of just policing the area. And so that was one of the keys, is that we are local. Not only we manage the property management side, so alignment of interest there, very very much so. Then also on the renovation side, we used our renovation company, Value Home Maintenance, to renovate all of this. So just basically we controlled all pieces to the puzzle. Hence we felt very confident in it. And so, you just kind of go in day one, and it's kind of crazy for the first few months, but you just see who starts paying rent, and whoever pays rent, well, they're on the nice list, right? Like Santa, right? And then the ones who don't, they're on the naughty list. And we stick to the same process. We don't treat anyone special or not. It's just rent's due on the 1st. You have a grace period till the 5th. On the 6th, it's late, 10% late fee. And then we start calling you, knocking on your door every other day or several times a week, and try to get you to communicate with us. Let us know where you're at on paying. And then if you don't pay by the 15th, then we file for an eviction on the 16th. And so that's it. Then because the landlord-friendly landlord-tenant laws, as you've kind of heard, we can get them out in a couple months after that. And so, yeah. And then also, of course, if any of the tenants are paying but breaking the law, or not being courteous or anything to the code of conduct, we obviously get them out as well. So that's kind of what we do, and just start returning all the tenant base. And so we kept a lot of the tenants, but a lot went out as well. So then a big thing too is just kind of, there's a stigma, right? People go and then they move out because it's too dangerous or too rough of a place. So you just kind of had to rebrand the entire community. So we took out the old name, put in a new name on this apartment complex, and just started creating a new community culture. One of the big things is we put no trash signs, don't throw trash. And the manager looks, they find people, and if they throw trash out and put it on the side or by their car, they'll fine them. And so the manager's walking the property every day, picking up as much trash as they see. And just that alone starts turning it around, right? And we put in nice dumpsters and actually empty the dumpsters, frequently. So because by the dumpsters, it'll get full and people just toss all their trash around it. So that creates an issue. So we make sure to have those emptied. I mean, just basic, kind, courteous, logical things. I mean, this all sounds like that. It sounds like rocket science, but it's not. But it's surprising how many people just don't do these basics. Another thing is that as new tenants come in, we're actually, answering their phone calls or greeting them when they come into the new management office and touring them with the unit. So just the basics of good customer service for new tenants coming in, and letting them know the ground rules up front. Like, hey, we don't play around. Here's how rent's collected. Here's the process. Here's the rules. Here's the code of conduct. Just all that. It's just communication and all that. So then, of course, we do extensive renovations, and we start the exterior because, number one, you don't have to get inside. There's no tenants you're disturbing. And also it just kind of paints a whole new picture for all the tenants that we're here to stay. We're not playing around. It's going to look amazing, just like the outside and the inside. So we did a lot of exterior work, and we'll show you some pictures on that. And then we renovate the inside units, especially the vacant ones first, of course, as there's a bunch of vacants, so it's easy there. We renovate 5 to 15 at a time. Economies of scale. A crew can go in and cut, the same board or the same piping. They're all pretty much the same floor plan. So he just, once when he does one or two floor plans, he knows exactly, he almost memorizes the measurements on everything and the materials needed. So they can just roll on through. So they do it a lot quicker and for a lot more cheaper economies of scale. But also, you don't want to renovate like all half the units right then, because then you spent all this money and you're paying interest on that money. Because as we draw against the renovation loan, you have to pay interest on it, and it's just kind of held in reserve and use it, and you pay for it. So you don't want to renovate too much and be too far ahead of yourself. So we kind of have a cadence and a pace that you work with the property manager on for figuring that out. And then as the tenants occupy, then you renovate some more. And obviously from there, we can raise the rents. We started raising the rents. We targeted at $695, $750, but as the market started growing and the place started gaining popularity and demand, supply and demand, we actually getting rents up to $895, $950. So we were able to increase rents $300 a door plus. And we just kind of watched the market as that went on and the supply and demand that came in. And obviously screen and place great new tenants into the community, right? We want to create a great culture and vibe. Just good paying people that stick to the rules, right? And we will do our part as well. We will fix the property, keep it good, clean, and safe. You pay your rent and treat others well, and don't trash the place, right? It's pretty easy, but harder said than done. So here's kind of the reno as it's going on. We did a lot, all the roofs as mentioned, and the siding. We started painting the bricks. Obviously, there's a toilet out there. We replaced a lot of the toilets, a lot of plumbing issues, electrical, just the whole shebang. And cosmetic on the interior, new kitchens, cabinets, countertops. Big things that helped out with this reno and increasing the rents was putting washer and dryer units in here. Before there weren't. So it was really hard. People would have to go. It's inconvenient to have to go to a laundromat or an on-site laundromat even. So this made it a lot easier for the tenants by having washer and dryer units. I mean, this is awesome. Just the crews just rolling down several units at a time, getting this exterior siding that lasts longer and looks better, rolling in. A lot of the sidewalks. So all this reno, kudos to Jim Reedy, Valley Home Maintenance, his team. We've talking with Jim Reedy, my partner, senior partner. He has renovated over 7,000 doors, 7,000 doors over his 40 years plus here working in Memphis. So I would say that's probably more, I would dare say, than anyone in Memphis, Tennessee, at least, of renovations. So we've been around the block. Anyways, it's an amazing job. So anyways, yeah, lots of sidewalk work, landscaping. As you can see, it's kind of fun to see this heavy equipment in here. This is awesome, impressive work here. A lot of erosion happened here, so I had to fix some of the units and put little fences around them in the entrances, just so it's a little more private for the tenants. So here's kind of the story. I graphed all this out. So we had a goal, right? In blue is our occupancy goal. So obviously from just above 50%. And then in 2 years, we want to be above 95%, 96%. That's when it's really stabilized as 90% plus occupied. The red represents actual occupancy. So as you can see, we obviously, in the first 3 months, we actually found out of the 50 whatever percent tenants that were in there, some of them weren't paying. So we had to get rid of them as too. So it had dropped near 50%, and then started climbing back up as we started gaining some ground and kept the tenants in there, and then just really started getting stabilized towards a year and a half in. I mean, we're in the 90%, which is in the green zone for a refinance and calling it stabilized, where you can get some nice long-term Fannie Freddie debt. So just really awesome. Smashed our goal on this. Of course, like, it does have a factor to do with how good we are at screening and getting tenants in and customer service. But a lot of this also, is the mercy of the market. The market was really good at this time. A lot of supply and demand in Memphis. Memphis was one of the top Google searches for properties for rent in the country. So it did amazing. But obviously, a lot of that has to do with macroeconomics and us zoning in. So here's some after photos. So obviously we painted the brick, nice screen door. So these screen heavy duty security doors, put it on every unit. That's nice for just the tenants' feeling of safe and everything like that. The nice siding, some landscaping, just, hey, not a piece of trash on the property, right? There's just everything like that. It looks amazing. Fixed some parts of the fence that were broken boards, and lots of whole sections as well. Here's the interior. So yet again, I mean, these are 2 bedroom, 1 baths, 800 square feet. So these aren't huge, luxurious mansions, but they're nice, clean, and safe. So we had, oh yeah, washer and dryer right there, stackables, which was nice in the kitchen, and then just your basic appliances and cabinets and countertops. Here's kind of the living room area, new blinds, obviously paint, new LVP floors. Just all the basics. Kind of this was the model unit, kind of making it feel homey that would show to the tenants. So just a nice, clean place to live. All right, to the numbers, which is what I like is the numbers part. So after basically about 2 years of owning this property, we're able to refinance. Okay, got it up to 96% plus occupied, high collection rate. So the average market rents are $850, and really we're pushing $950, $900 in a lot of the units, like currently as of today's rent. So, but a $300 a unit rent increase, which is massive. Most people increase the rents $100 a unit. Now that's because there's not much room to grow. We obviously had a highly distressed asset. So this puppy, as you remember, we bought it for $3 million. It appraised for $11.1 million. Now, obviously, we put a lot of renovations into it. We had an initial investment of $2 million, as mentioned, of equity. The rest was debt. And so we were able to pull out $1.6 million of our initial investment, or 80.8% of our initial investment back out. So we still own it, all our same percentage, but now we only have 20% of the money that we put in originally in it. Okay, so owning a $11 million asset for $400,000 down, basically. So that's very low down, I believe, like 4%-ish. So yeah, 4% down. Now, obviously, you had to put more in at the very beginning and keep it in, but now you've pulled it out. So lots of. So this is the awesome part of multifamily and real estate. I've already explained cash out refinance is that you can take your chips off the table. You like, yes, you put the 20% down, but like this one's quick because it's 2 years, but 5 years, 10 years, you definitely can pull out almost all your money. I think definitely in 10 years, depending on the market. So that's amazing. Just blows my mind. You can own it for that little down. And I've seen lots of case studies too, where you can have even more pulled out than what you put in. So now what's awesome is that money, that 1.6 million, came back to all the investors, pro rata proportionally to how much they put in, 100 grand or 500 grand or $1 million, right? They got their proportional 80% of it back. And so now that 80%, you can go do whatever you want. You can go invest it again in another deal, put it in the stock market, lend hard money, or put it for savings. So it's kind of just shows that it can grow exponentially, and do another deal, and 2 years later pull out that money and go from there. So this is a little complex. Bear with me, go a little slow. I'll go slowly here with you to kind of explain this. It really, though, paints the picture and helps you just see kind of the value in our projections. So obviously year 1 and 2 are actually actual numbers, and then projected from years 5 to 7. We plan on selling it in 5 years, but who knows, depending on market conditions. So obviously year 1, we put in 2 million of beginning member capital account, 2 million of equity. So 100% was invested. And we didn't have money for the first 2 years because we're putting a lot of the money, reinvesting all of it back into the renovations. So no cash on cash return for the first year. So there's pros and cons to this strategy. You're no money for a while, but wait till year 3 and you'll see how awesome it gets. And so nothing going on. So at the very end of year 2, though, you got 80% of your money back. So there's only 384 left in. So now here's where it gets awesome. For this year, we're projecting, and this is, pretty conservative numbers here, but getting 122,000 of cash flow, or of your money left in. So this cash on cash return is your, the cash flow divided by the capital account balance. So 30% cash on cash ROI. I think that makes up for the first 2 years of nothing. And actually it does. So average cash on cash return is, how much cash in total, in perpetuity we've made divided by the investment. So 10% is our average cash on cash return. All right. So it almost makes up for it at that year. Then every year, we plan on a little bit more cash flow coming in. This is because we're catching up of a preferred return. Then year 6 and 7, that drops down. But yeah, anyways, a 30 to 35 to 28% cash on cash. On average, the cash on cash return is 23%. amazing. I would freak out, be jumping for joy at, 4%, right? So multifamily is pretty awesome. And that's just cash on cash. There's the investors also got a lot of tax benefits from this tax write-off. So you're not paying taxes on those. And if you're a full-time real estate investor, as Chris Pucuros mentioned, the accountant from day, I believe, too, that it gets even better. So average annual return to date, there's that, pretty similar, except for this gets bigger. Why does this get bigger? Because there's net proceeds. So this is cash on cash only. This isn't factoring in equity. So when we sell in year 7, so in 5 years from now, we will be able to get back $2.9 million in proceeds. This is us projecting they're selling at 110 a door, which is only they appraised at 90,000 a door. So it's only a 4.4% appreciation for 5 years on average appreciation, which I think is conservative, but we'll just leave it there. So $2.98 million pulled out year 7, which therefore bumps up the year 7 return because you have your cash on cash return of 108 plus 2.9 million. So 3 million, which is right here, total return on investment for that year. Okay, so an amazing return that last year. And that's real estate. You make a lot of the money from principal pay down and appreciation when you sell, right? And so total returns, so 644,000 in total cash flow. That's the sum of all this 2.98 million in appreciation and mortgage pay down, et cetera, et cetera. And obviously the return of all the member capital, because you get your capital back. So all of your money's returned back as well for the rest that's left in. So total return of $3.5 million on 2 million. And then so a return of 178%. And if you average that out, it's a 24.5% average annual return and IRR because you refinanced. So yeah, amazing. Excuse me. So there's that. Those are all projections, but feel pretty confident, feel like it's pretty conservative. All right, and on to case study number 2. So we purchased this October of 2020 for 2.9 million. And it was same story. I'm not going to go through the whole model and everything. We did basically the same exact thing, very similar, very within the same realm of each other in the southwestern, southeastern part of Memphis by FedEx. The occupancy was 50%, and we put an initial investment of equity of $2.5 million. So here was the stabilization. It obviously dropped a little bit as well because we had to get rid of some of the inherited tenants, right? I don't even know, the stepchildren we inherited, whatever you want to call it, and then it started going up and we started raising rents and everything like that. Got up to about within a year, up to 90% occupied. And so we're still rolling from there. And so here was so once we refinanced in 2022, just recently, it appraised for 10.8 million. We got a 65% loan to value loan. Cash out, so $7.049 million loan out. Let me explain the loan. So both these loans were the exact same as the first one, the 124 unit and this 128 unit. It was a 4.69% APR interest rate. Okay, that was just barely locked in. So I mean, rates are still pretty good for multifamily, is based off the 10-year treasury and some basis points above that. It was a 10-year term. So that means in 10 years, the loan balloons. You have to pay it all off or refinance. Obviously, you just refinance. That's the traditional way of going for it, or sell it. It was though 30-year amortized. So the loan is amortized over 30 years. So, and then what was also awesome, it helps our cash flows with 5 years of interest only. So, and that's why we want to sell in 5 years, is because then it starts paying principal payments and it lowers your cash flow. So that just helps the cash flow for the first 5 years be way amazing, like mentioned, 30%. And so we were able to cash out 2.1 million of equity, and we left in then around almost 400, little under 400,000. So 84.4% of your equity cashed out. Yet again, amazing. Jumping for joy. I invested in all these deals. We all invest, and all the partners invest our own money. A significant portion of that 2.5 million raised is our money, right? So we're enjoying the fruits of our labors, and also we're in it through the thick and thin. Either way, it's a significant portion of our wealth, and everything is in all of these deals. So it matters. We're here with you. We're not gonna do this, just with all investor equity. I'm going to show some skin in the game. All right, so this now shows the returns. I'm not going to go in quite as much detail as before, but yet again, the first 2 years, no income because we're heavily renovating it. Pull out our money, so only 400,000 is left in. We get 142,000 as our projected cash flow, so a 36% cash on cash return on investment of the money left in, 12% average annual return, and then it gets up to 27% average annual return. Total cash flow of 748,000. We're going to sell it yet again, 110 a door-ish. So 3.2 million pulled out, 147% average annual return to date. And then 160% total return on investment, 4 million total equity in return of money. All of your money's returned, and a 23.68% average annual return, or IRR. So amazing. I think it's somewhat conservative. Yet again, only a 4.5% appreciation, 4.4% appreciation estimated. And yeah, pretty exciting. So thank you guys so much. I appreciate you listening in, checking us out. Please make sure to subscribe to our YouTube channel. Please support us by, subscribing supports us, commenting, watching us, but also telling your friends about this, about what we can offer, buying some of our turnkey properties or investing with us. And we're so grateful for everything that you do. Thank you so much. Have a good one.